All right, I want to have a look at paying extra off your home loan as a set weekly amount of additional repayments. Unfortunately, this isn't spoken much about from the banks or from some mortgage brokers. My preference when entering a loan for a customer is ensuring that is affordable. And affordable does not mean that if you can borrow 600,000 and your maximum borrowing, you borrow 600,000. It's not that on that 600,000 loan, your repayment would be 3,600 a month and you can afford that 3,600 a month. Affordable would mean that you can comfortably afford that amount plus an additional amount that you make each and every week. So if we have a look at, and I spoke about accelerated repayments previously, but let's strip the accelerated repayments out of it now, and let's just look at a stock standard weekly repayment. You still should be looking at accelerated repayments, which I explained in the other video. But let's just have a look at if we make an extra couple of $100 a week repayment to it, what that does to our home loan, okay? How quick we can pay it off and how much interest we can actually save. So a $600,000 loan over a 30-year period at 6% rate, which is current rates right now for an owner occupied. 600 is about the average loan size that we see. Repayments each week would be $830. Okay. If you just made the minimum scheduled repayments that the bank tells you to make, you're going to repay that loan off in 30 years. Your total repayments will be almost $1.3 million. Okay, that you'll make. That $600,000 loan has cost you more than double. So the interest that you're actually paying back over that 30 years is 694,000. There's been a lot of stuff recently about with interest rates rising, some lenders offering extended loan terms, some as high as 35 years, which would bump your interest up to over $800,000, and some even to a 40-year home loan, which would take that interest up to about $1 million or just under $1 million that you're paying. So go back to 30 years, which is more standard. Total interest 694,000 over that 30-year term. Uh, on a $600,000 loan, repayments of $830 a week, I would be building in at least a $200 extra per week repayment. So if your loan's affordable for you, you should be able to make those additional repayments. 830 should not be your ceiling, okay? It should be your floor. You should always be paying more than that minimum repayment that the bank tells you to pay. And this is why. So making that extra $200 per week, which is just over $10,000 per year, instead of paying that loan off over 30 years and paying $695,000 in interest, your loan would be cleared in just under 19 years, okay? Almost 18 and a half years. And your total interest bill would be $396,000. Okay. You would save close to $300,000 just by making that extra $200 per week. That's the interest saving. Okay. So it's important if we're taking out a loan or if you've got a loan now to make sure that we are not just making the minimum repayments. Okay. Minimum repayments will work against you. It will keep the loan paid out over a longer term, which is going to maximize the interest that you are going to pay to your lender. They are going to make more money because you are only making those minimum scheduled repayments. Okay. So what you need to do is you need to start increasing those minimum repayments. You should be aiming on a $600,000 loan to be doing an extra $200 per week. Maybe right now that's not affordable for you. Okay. So make an extra $20 a week. Okay. Make your accelerated repayments. Set it up as an accelerated repayment. Then start increasing this figure. Okay, an extra $20 a week will save you 50,000 over your loan term. You'll pay it off a couple of years quicker. Then you can build it up to extra $50 a week. Okay, that'll save you over 100,000. Then you'll get up to $100 extra per week. That'll save you close to 200,000 in interest. Okay, then you might have to bump it to $150 extra a week. That'll save you $250,000. Okay, until you can get up to at least $200 extra per week that you're repaying on your home loan. Now we look at this and say, okay, that's a massive saving, almost $300,000 that you're saving. But I want you to consider the other benefits of this in the time, because really what we're getting back is time. So picture this. You're 30 years old. This is your first home, or this is your house you've purchased. Okay? You're paying it off over 30 years. So that loan term, if you're making minimum repayments, the loan's going to be paid off when you're 60. You ideally want to be retiring at 65. Most people want to retire earlier, but a lot of people don't have the plan in place to do that. So you at 60, you're going to retire. At 60 years of age, you're going to be debt free. Okay, you've got 5 years left of working, then to build your superannuation, things like that. Now, like most people, there may be a renovation, there may be a home upgrade, there may be something else that happens, and that can easily extend that loan term to 65 or even past that, just making scheduled repayments. But think about it this way: if you do make that extra couple of hundred a week, or if you build that in, maybe you purchase a house, maybe instead of buying a house or taking a loan out for 650, you take it for 600. That way you can afford to make the extra couple of hundred per week. Maybe you get some pay rises and you start to increase that additional repayment that you make each week. Maybe you pick up a side hustle or something like that, make some extra money to actually make that extra $200 per week in repayment. So let's fast forward that you've made those repayments and now 19 years later, you're debt free. Okay. Instead of paying it off 30 years, you've now paid it off 11 years earlier. Okay. House is paid off. Your expenses are lower that year. You're saving $830 a week, or $1,000 a week then, because you were paying the extra 200 a week. You're paying $1,030 a week. Now you've got an extra $1,000 a week disposable income. Okay, house is paid off. 11 years to go in that standard 30-year period. First year, the extra 50,000. You take a holiday, do something like that with the family. Then you have another 10 years. Over here, you still have another 10 years where you don't have that mortgage repayment anymore. The $1,000 a week that you were paying, now you don't have to pay it to the bank. You don't have to pay it to the lender. So for that next 10 years, there's $50,000 a year extra funds that you've got. So that could mean that in that scenario, if you were 30, okay, instead of paying off the home loan at 60, you're now 50. Then you've got, instead of waiting until you're 65 and to do some holidays or trips around the world and things like that when you're retired, now we can start sneaking those things in our 50s. We've got this surplus income. We can then go and start doing some of these holidays and some of these other things that tick off our bucket list before we actually get to retirement. We can start adding a lot of these expenses and things like that before that, spend it. We can use that 10-year window, the 50,000 a year or 500,000 over that 10-year period that we've saved. And we can then start making additional contributions to our superannuation. We can start investing personally. We can maybe purchase an investment property. We've got the surplus cash flow there that we can use to bolster our retirement position. When I'm retirement planning for clients, one of the biggest advantages that I see for clients getting in the best situation, it doesn't have to typically be, you may be that you've got a massive amount in superannuation uh, at 50 or at 55. But if you've then cleared your mortgage at that age, then you've got that last 10-year window, which I call the sprint to retirement, where, yeah, maybe your superannuation balance isn't that high, but you can then increase that. You've got the extra cash flow to then go and really start to accumulate. We'll get serious about it and build that superannuation further. You could already have been making extra super contributions when you first started working. But if you haven't, you're gonna be in a lot better situation if that home loan is cleared at 50 as opposed to at 60. Unfortunately, I do see quite a few people that it's even 65 or even 70 that they're projected to repay off their home loan. And it can really derail your retirement plans. You really do not want to be retiring and have debt and be taking a lump sum to pay off that loan. There may be a strategy in there for last 10 years. We make extra contributions to the super, knowing that we have to draw down and repay that loan. But you want to be making sure that that's part of a sound strategy for actually making additional, and you're just making additional repayments to super for tax savings to then repay your home loan. Your ideal position is 10 years before your retirement. When you enter that sprint to retirement, you don't have a home loan to repay. And the only way to do it is to make extra repayments to your home loan. If we think about accelerated repayments, which I explained before, accelerated repayments is paying a higher amount each week, which which results in that you end up paying 1 month's extra each year. Okay, in this example, it would save you about 5 years. So you pay off the home loan in 25 years, not 30 years. So that's a good start. If you're not already doing that, you should be doing that, but you really need to think about making these additional repayments to your home loan, an extra couple of $100 per week. If your loan's higher, then you have to start making more than that, than the extra 200 to get the big savings. We need to pay that home loan off there earlier, and the sooner the better. We don't have to put everything into the home loan, so you can, if you're doing other investments, you're buying investment properties, things like that, if you're adding more to super, that's great. But the extra, if you can get this 10-year window where your loan is paid off 10 years sooner, that's going to allow you to really boost your superannuation. As I said, bring forward some of those holidays and things like that. And then have the opportunity to really set yourself up for retirement. Funds may be tight. Interest rates have gone up a lot recently, but just please start increasing your repayments. Maybe you need to start with an extra $20 a week. Okay, then start increasing it. But get into your mind that you are going to be making an extra $200 per week repayment on your loan, minimum. And if you're unable to do that now, then any extra income that you get, or pay rises, things like that, or any subscriptions or expenses that you can reduce or cut, the savings from those or the increased income from pay rises will go into being able to make this extra $200 per week. Maybe you even need to think about other income sources or getting a higher paying job, or maybe upskilling at the job that you're at. Maybe making yourself more valuable to your employer if you're employed, or if you're on your own business, making some changes to produce some more income for yourself to get this home paid off quicker.